It is officially over. For years we speculated, studied charts, tracked open interest, and wondered when the banks would finally break under pressure. The entire financial system would be forced to bend the knee publicly. We believed bullion banks were dangerously leveraged, trading fractional. Reserve paper against a physical asset that was quietly running out. Until this morning, that belief was theory, probability, mathematics, but not proof. We lacked the smoking gun entirely. Today, the guessing ends. The body has been found. The theory is now confirmed reality beyond any doubt. While silver surged and celebrations filled screens, something far darker unfolded deep within the plumbing of global finance. Something the mainstream media fears reporting because it proves the banking system is fundamentally insolvent. This morning, official data arrived from the Federal Reserve Bank of New York regarding overnight repo operations. The number flashing across terminals was not a typo, not an error, not a technical glitch. It was a confession, massive emergency borrowing during the quiet hours after Christmas. Too big to fail, banks tapped the Federal Reserve's emergency liquidity window simply to survive. This is not where healthy banks go to fund growth or expand operations. The repo facility is the pawn shop of last resort, the emergency room for financial heart attacks. Strong banks avoid it entirely. Borrowing there is the walk of shame of global finance. So why did the masters of the universe suddenly need emergency cash at dawn? Not payroll, not operations. They needed it because they were bleeding to death financially. They had just received the largest margin call the commodities market has ever produced. Silver gapped violently higher overnight, teleporting upward while markets were unprepared. Banks sat on massive short positions, sold far lower, expecting another routine suppression. They expected fear, liquidation, stop-loss cascades, and easy buybacks. Instead, nobody sold. Retail held firm. China held firm. Vaults were empty. Price went vertical. Every dollar silver rises creates billions in losses across leveraged bank balance sheets. Unrealized losses can be hidden temporarily, but margin calls cannot be avoided. When price moves violently, clearing systems demand immediate cash without negotiation. That demand arrived this morning, and it was enormous. Banks checked their ledgers and realized the terrifying truth. The cash was not there. Illiquid, insolvent on a mark-to-market basis. So they gathered remaining collateral and ran straight to the Federal Reserve. They pawned government bonds just to remain alive another trading day. This was not stimulus money. It was a tourniquet, stopping catastrophic bleeding. Notice the timing carefully. A Friday after Christmas when nobody was supposed to watch. Bad news is always buried on Fridays. This was deliberate concealment. For decades, suppression worked because banks had infinite paper and sufficient margin cash. Liquidity crises kill paper games instantly. Without margin, you cannot short. This borrowing represented the bottom of the barrel. Banks exhausted their own money and turned to taxpayer-backed liquidity. Everything changed at that moment. We are no longer fighting banks alone. The Federal Reserve has stepped directly into the battlefield. The Fed can print dollars endlessly, but it cannot print physical silver. Printing dollars only devalues the currency, driving silver even higher. The bailout accelerates the exact force destroying the shorts. This is a self-defeating feedback loop with no escape. Higher prices require larger bailouts. Larger bailouts fuel higher prices. The first rescue will not be the last. History shows liquidity explosions always start quietly before becoming uncontrollable. This crisis is not about interbank lending. It is about silver. Margin support represents enormous hidden exposure beneath the surface. This is not a crack in the hull. It is structural failure. Only systemically important banks carry silver exposure this massive. The same banks mocking silver are now pawning treasuries to survive it. This moment vindicates every physical holder who endured years of ridicule. The proof of terror is visible in emergency borrowing. Do not let anyone gaslight you into calling this normal year-end behavior. Normal window dressing does not occur during explosive silver rallies. This was a margin call, pure and simple. Ask yourself honestly what happens if price keeps rising. Confidence in banks evaporates as emergency liquidity expands. This crisis begins not with mortgages or stocks, but monetary metals. The Fed is now managing silver indirectly through liquidity. A system on life support cannot suppress a bull market. The suppressors are bankrupt. Ammunition is gone. Only a weakening printing press remains. Infinite paper finally met a finite margin constraint. Leverage magnifies small moves into existential threats. Clearinghouses demand cash immediately, not future promises. Risk models detonated simultaneously across institutions. Liquidity bought time, not safety. Cash solves margin briefly, but metal settles contracts permanently. Contract holders now demand delivery, not settlement checks. Physical demand is overwhelming available inventory. Vaults are strained beyond historical precedent. Forced buying into shortages becomes rocket fuel. Paper vehicles are being cannibalized to plug delivery gaps. No bailout can manufacture atoms. Failure to deliver ends the paper market permanently. Short sellers have capitulated, proven by collapsing borrow demand. Falling borrow costs signal retreat, not confidence. Sell-side liquidity has vanished entirely. With shorts gone, nothing caps the upside. The Federal Reserve has placed a floor beneath silver itself. Downside means bailouts. Upside means inflation that guarantees higher nominal prices. This was the pivot, delivered silently through panic liquidity. The dollar was sacrificed to save the system. Silver now reflects that reality, and the repricing has only begun.